Hi everyone, how are you? My name is Chris. I'm a. Oh, sorry.
Perfect. No, it's perfect. It's fine.
My name is Chris. I am an investor in Deeptech startups, which, as I'm sure you'll come to learn, there aren't a huge number of investors in Australia that have that focus. Most are focused on SaaS, but hopefully what we can talk about today is how to find and engage with those that are open to robotics and in fact prefer robotics or Deeptech. So I first started working with startups about 8 years ago with an aerospace startup called HEO, which still operates in Sydney at the moment. UNSW based initially, but if you can ignore that, they are quite a good company now. In fact, they're an amazing company now, selling images to the US Defence Force, the Australian Defence Force, and a bunch of other companies. I am a mechanical engineer from my background, and then studied an MBA to move into finance. So I like to think that does give me a good view on both the deep tech side of startups and the finance side of startups. And then I think you'll find that there are more people like that moving into investing over time. There are more people interested in deep tech in Australia now than there used to be. So today we will run through who they are, because they do differ by stage and a few different things, and then also what do they want and ultimately how can you best engage with them. If you've got any questions that come up as we go, feel free to throw up a hand and ask them. We'll also have questions at the end as well. So I guess the first thing to know about investors is that they are looking to make money and make returns for their own investors, their limited partners. But that's not how they will be thinking at the time of investment. They will be thinking about reducing risk. How can we minimize the risk in this company and minimize the risk of our investment? And the way that I like to think about it, and actually, let me just clarify, all investors do think a little bit differently. So this is the way that I think about it, but it doesn't mean that another investor will think about it exactly the same, but hopefully it's similar enough. Well, actually, investors with different theses are a good thing, because more broader companies get funded. So actually, I hope there are some that don't think this way as well, but hopefully a bunch of them do. Well, I'm really out on a limb by myself. The way that I'll think about a company, though, is that on day one, everything is risk. There is absolute risk in that company. And over time, the company needs to take steps to reduce that risk over time. An example that I've got here is that by building a proof of concept, you are reducing the risk that the investor will see in the team. You can build robotics and you can get a project to completion and to test. You'd definitely be reducing the product if it was the risk in the product if it was a successful test, and a bunch of other things. Unit economics, which are the balance of what you can charge for something versus what you can make it for. Over time, as you begin manufacturing, the cost will come down, so the unit economics will get better. But until you have built that first one, you obviously don't know exactly how much it will cost. So being able to turn that from theory into at least a production run of one reality will reduce the risk. And as well as building a proof of concept, the way that I would think about constructing and building a company is that everything you do should be reducing the risk. And it's not just for the investor, it's for yourselves as well. If you are doing something, well, especially in robotics, when you're doing something, it's more of a hypothesis, not we will build this SaaS product and sell it to a large bunch of companies, but we will create a product that no one has created before. And so there are inherently unknowns and risk for the founders. So by thinking about a company in terms of risk, you can reduce your own personal risk hopefully as you go along as well. As I mentioned, everything you do can reduce the risk. Obviously, finding a large bunch of co-founders, not necessarily a large bunch, but since actually have differing opinions on how many is the optimum. But by having more than one, you are reducing the risk of having enough skills, the risk of having a large enough network. If you have a business founder as well, the risk of understanding the marketing and how to build out unit economics, and how to build out it's the business side of manufacturing. So even at those very early stages, you are still able to reduce risk. And to expand on that, each round that you raise from the idea, which isn't really around itself, through pre-seed, seed, Series A, and beyond, the investors will be thinking, right, what risk has been reduced during that period of time, and that will lead to a valuation increase, which is what the investor is ultimately looking for between the rounds, and you add up enough valuation increases, and then you have a $1 billion exit. At the pre-seed, the risks that, at least that I think about most are, is this even possible? And do people find this problem painful? It is one risk with engineers is that they focus very, very heavily on is this possible, but not so much on how painful is this for the customer. You can de-risk that a lot by talking to them or having worked in the industry, or proof of concepts, and especially paid proof of concepts are a great way to do that. But that pre-seed is really, can our solution work? That is the risk that I believe you should be de-risking it during that phase. The seed stage is, can we turn that proof of concept into a product? And do customers want that product? Which is slightly different to, is it painful? Because things that are mildly painful might actually be easier to just leave painful if they worry that there is a high risk of operational disruption. So, for example, with manufacturing startups or startups that are working in a manufacturing line, the pain for disruption of that manufacturing line will need to be so great for them to risk making however many widgets they make in a day, that it is astounding sometimes how much pain I've seen people put up before they're willing to risk that disruption. And I'm really hammering that point home because that customer side is a really important part. Just being able to do something doesn't necessarily mean someone will be able to pay you, that somebody will pay you for it. But that is ultimately what you are trying to de-risk at that seed stage, is will somebody pay for this? Series A, it starts to, you now know that there's a problem, people will pay for it. So you start moving towards, can we do this whole thing repeatedly? Can we sell repeatedly? Can we make this repeatedly? And will people pay for it repeatedly? And by the time you get to Series A, you're really at the stage of, can we do this 100 times, not 10 times? And do we know that when we invest X dollars into this, that we'll get Y dollars out? And the investors will be thinking about it in exactly the same way. And then down the bottom, I've classified investors into a couple of different reasonably well-known types, and that maps to the stages above that they generally get involved in. Angels are your very early stage. Then there's two different classes of VC, and splitting them out isn't always done, but they do think quite differently. And I'll run through the differences shortly. But then much further down the end is private equity and family offices, as you can see, just run a gambit of things. I guess that really highlights the fact that all investors do. So to summarize this slide, just as you are thinking about your company and the de-risking that you will need to do, it will need to change as you go along the life cycle of the company, and the investors will be expecting to see those changes along the way. So angel investors, they are the first investors that you will probably engage with. They are your high net worth individuals. They are often operating alone or possibly in syndicates, and I'll touch on those later. They invest more emotionally than other investors do. They have no investment committee, and I'll run through what an investment committee is shortly. But that enables them to make a decision by themselves and not have to convince other people in their company to make a decision as well. That can have both a benefit and a negative. They can, on a whim, decide to invest in your company. And I have seen that happen, where after talking to hundreds of investors one angel just decided to take the whole round for a company after one meeting, and that enabled the company to grow into the large company that it is today. But without that one person, it never would have been able to take off. But on the other hand, if they decide for some reason that they don't like the industry or they don't like your approach, then there's very little you can do to convince them. And it's very hard to tell what they think before they meet them, so you can burn a lot of time talking to a lot of angels before finding one that just happens to gel with you. They generally have smaller checks, which works out well because they're investing in the early stage where a company probably doesn't need as much money. And we'll get onto timelines more because they're more important with VCs, but just note that angels are patient. They don't have a timeline where they necessarily need those funds to come back to them. So angels are flexible, probably annoyingly flexible at times because you won't be able to put them into a bucket, but they will be those first believers in your company, and they will invest with their heart. They will use their head as well, but more than anyone else, they'll use their heart. So a little bit later on, you get to early stage VCs. That is a move from the angels into what we would call an institutional investor. So they have a company, they have a fund, and they have investors that invest in that fund. So they are deploying other people's money, which comes with a lot of responsibilities as well. They will have an investment committee, which means that the investor that you are talking to will probably be leading the deal, whether they're a partner or not, but that person will then also, as well as you having to convince that person will have to convince their investment committee that this is a good idea, which means some of the emotion is intentionally taken out of it, but also different ideas are starting to come in at that point. So it is a harder bar to get across. On the other hand, these investors will have a mandate that they've raised from their own limited partners, and they will put that on their website. So with a little bit of research, you can start to see what are they interested in, should I even talk to them? And the first check, especially for this group, would be that are they open to robotics, or are they just a SaaS investor? And as I said, most will be explicit. With a little bit of research up front, you can really target your approach to those investors that are interested in what you're doing. And it does take a little bit more time, but I would even go further and target your pitch deck to their particular thesis or mandate that they've got on their website in order to really nail home with them that you are right in the middle of their hidden zone. Early stage investors also have smaller checks, usually up to $1 million in a first deployment. Then investors at this stage and above will invest multiple times usually. There's an investment theory that you invest in a company and you do need to expect large returns from that company, but when that bunch of companies done a first investment into comes back or begins to raise their second round, if by then you can tell which ones are becoming more successful, and you can double or triple down and reinvest twice or three times in those companies, that can lead to greater return to the end of the fund. And a lot of investors subscribe to that and will be looking to do further investments. Where that starts to play into their timeline is that because this is a more formal fund, it has a life cycle of 10 years. They have to raise money from investors. They'll usually deploy it over 5 years, and then help the companies manage they will manage their portfolio and get exits within that second 5 year period. They do have the ability to extend a couple of times, a year or two at a time, but at the end of that fund, they have to exit. And it is a conversation with the founders, and it is something that has to be done as sort of a whole of company, investors and company decision. But at the end of the day, however they're getting out, they have to be out. They have to return those money to investors. For you, that means that when you do engage with investors, finding out when was their fund raised, when was their first deployment, you can start calculating how much longer of their fund do they have. are they 4 years into the fund, which actually means you don't have 6 years, sorry, you don't have 10 years to exit, you have 6 years until they'll be looking to exit. For a robotics company, that becomes a lot more important because the timelines can be a lot longer than just a software company. So picking your or timing your raise to the investor's timeline, or rather making sure the investors coming into your raise are at an appropriate point on their own timeline, can be incredibly important. It becomes heated when some people need to leave a company or leave a capital table and others want to stay. I've got some examples here. Rampersand is a VC that I worked at for 4 years, and Salus there is an investor that I work with now. Very hard to tell from their logos, but Rampersand is a purely SaaS investor and will not do much deep tech at all, whereas Salus does a lot of deep tech, not exclusively, again, but very much at the other end of the spectrum. These other investors that I've got up here are all open to deep tech to varying degrees, but that's not a bad list to start looking at. There's also Airtree, which is the bottom logo there, has a list online of investors in Australia where they have self-selected what industries they're open to. By filtering that by deep tech, you can find people who are at least open, although I can tell you there are a bunch of people on there that have flagged deep tech that I wouldn't say are that open to it, but at least it cuts down the list somewhat. Moving on to later stage venture capital. So as you start getting out of Series A, or sorry, as you start getting out of seed into Series A and Series B, you'll be looking at a different style of venture capital investor. They, like the first one, will be looking for companies to grow rapidly. However, given that you buy the Series A and B stage and you're selling to customers, they'll be able to see what's your sales cycle like, what are your average contracts like. They'll start becoming more driven by metrics. The later an investor, and that goes all the way up to public markets, the more information there is out there, the more companies of different areas are understood, and therefore the more driven by acceptable or sort of best-in-class metrics an investor will become. That definitely kicks in at this stage. Very similar with a mandate and investment committee, except they might even have metrics that are required by the investment committee, so it can be even tighter to a mandate at this point. And late stage VCs can invest up to $10 million in a round, or even more sometimes these days. The funds are growing to larger size and therefore have to deploy more over that 10-year fund time. But again, usually a 10-year life cycle here. You'll also notice that some of the logos are the same between the early and the late stage VCs, and some investors, especially those with larger funds, can deploy across multiple stages and will cover both the early and the late stage VC. They can and do actually do this quite well. Sometimes they'll have different teams looking at different stages, which means that they can do it incredibly well. But finding out what stage an investor is before you reach out to them, again, will save you an awful lot of time, and you can tell quite quickly from the website. It's almost like a 2x2 matrix. So interested in my area, not interested in my area, at my stage, not at my stage, and trying to pick who is both interested in your area and invests at the stage of the company is will save you a lot of time and a lot of discussions later on. For example, Blackbird will invest from the very first check all the way through to pre-IPO in a company, and they have invested in companies that whole way through, whereas 5V will only start getting engaged at the Series A, Series B stage. I will touch a little bit on private equity. That's a completely different model to venture capital. That both are looking for similar returns at the end of the day, but they do take a different approach to how they buy companies or how they buy shares in companies. VCs are looking for growth. They're looking to invest in a small company at a low valuation and have that grow incredibly rapidly over that 10-year, well, maximum 10-year period plus the extensions. And and they expect a lot of companies to fail over that 10-year period. But the companies that do succeed, they expect to be so large that it offsets all their other returns. That's why VCs often talk about looking for a $1 billion company, because if you invest at sort of the $10 to $20 million valuation stage, when you run sort of the portfolio model through, $1 billion outcome is about what you need from your successful companies in order to offset the losses at that stage. But they are high growth focused, but willing to lose companies along the way. I'll touch on what is known as sort of the VC train or the VC pathway soon, which reflects that. But private equity, on the other hand, is more about avoiding losses and reducing costs in the companies that they invest in. So they are generally looking for already profitable companies that they can buy a larger stake in, but they are not tolerant of loss. They want those companies to grow a few X, and they don't want to lose, as opposed to the VCs that want companies to grow 1,000X, but lose most of them along the way. They're both looking for about 3 times return on the funds, but 2 very different approaches to getting to it. Private equity, as you are thinking about spinning a company out of the university, private equity is probably, well, it's definitely not the area that you're looking for. But as you are looking to potentially exit the company in 10 years down the track, private equity will definitely be an option, and will become involved at that stage. Private equity also doesn't have the 10-year fund. Some of them do, but some of them have infinite lifetimes. So when I look at a company, and I look at companies generally at the pre-seed and seed stage as an angel investor, and then also at the seed and Series A stage for Salus Ventures. I will usually break it into 4 different things on the company, or 4 different areas of risk in the company, and then I'll break the raise into 2 different things, and I'll structure my due diligence around that, and those are the areas that I'll be looking into. The team is what a lot of people talk about, the quality of the founders, but to sort of take it down another level of detail, I'll look for, what do you know that nobody else does? That can be in the product, like how can you enable something in robotics that nobody else can, or how can you achieve something that nobody else can? Good example is SpaceX landing a rocket on its thrusters. Nobody else can do that, and that gives them a huge advantage. But it's not just product specific. It can also be, what do you know about your customers that nobody else knows? What do you know about the sales cycle or the buying habits of your customers that nobody else does that can give you an advantage? It's important that it gives you an advantage, but it's that unique insight is what you're really looking for, or what I'm really looking for in a team. That then reflects into the product on how or what competitive advantage does your product have? How can it do something cheaper, faster, better than competitors? Or can it do something that competitors just can't do? The market is something that I look at, to be honest, less and less these days. But that is how big is the market? How big is your market, and how many customers are in? And you can look at that from how much do people spend on the market now, i.e., there is this much infrastructure spend in Australia every year, or you can look at it from what's known as a bottoms-up approach of, I want to sell at a price of this, and I know that there are X number of companies in the industry. So in the infrastructure example, there are 30,000 construction companies in Australia, and I know that I can sell to them for $10,000 a year. Therefore, my market size in Australia is 30,000 times 10,000. Very hard for a startup to create more customers, so that one is reasonably fixed, although often if it's a growing industry growing over time, but the price is something that you can play with in order to, once it's validated, to change your market size. The go-to-market, however, is, why I am less focused on market these days is because I think if something is a truly revolutionary technology, then it can create a market. So if something is able to bring, using the construction example again, the difficulty of construction down an order of magnitude, then there will probably be far more than 30,000 construction companies, or there will be far more than the number of construction projects that are run if you can bring the ease and the cost down. So markets can also be created because that's such an unknown thing in the future. It's very hard to analyze. It's hard to analyze. It doesn't give you much information as an investor, so therefore I spend less and less time on. Go to market, however, much more important in my opinion. That is how are you taking your product out to your customers? With SaaS, it is there are a lot of metrics around how much you're spending on Facebook, how much revenue are you getting for that spend, how many customers are turning up on your website. You'll find a lot of blogs if you look up go-to-market on that, but it's less applicable to robotics. When it comes to a robotics company or a deep tech company, what I'm looking for more is how many customers are you, or how many potential customers are in your close network? How many are you keeping up with? How many are you having coffee with every couple of months? And how are you learning from them how your product might impact their business? That once the product is then ready, that very quickly turns into, here is my sales pipeline of people that I know really well and I know their problems, and this is how fast I'm starting to move through and sell to those people. So it's a much more, I guess, sales-driven kind of go-to-market, but having that really thorough understanding of, there are 200 potential customers in Sydney, and I've talked to the last 50 of them in the last 3 months. This can be very powerful for investors because it shows that you know who you're selling to before you have to sell. The other option is to go and just get revenue from them. That is ultimately better, but at the early stages, very hard to do. When a VC or when an investor starts doing DD, they will begin asking you a bunch of questions on all of these things. They'll probably ask you to build a data room for these things, which is effectively a glorified Google Drive file where you can put your company information to answer their questions. A couple of things that, as you're considering doing that, I would also start a running list of all of the questions that they've asked, because those are probably the gaps in your data room. So you can start to answer those up front with new investors to get them to the next level of questions. And also that will help you tailor your pitch deck as well in order to answer that. If you can see repeating questions coming from investors, those are probably important questions. Those are probably important questions to answer. When it comes to looking at the round, so assuming that I am on board with everything that is with everything in those top 4, then I'll start considering the round, how much money you're raising. I'll look at what does that money unlock. So what will you achieve during the period of investment that you can't do without this money, that will lead to a great reduction in risk over that period of time. And that might be actually generating some revenue and selling to customers. That might be proof of concepts. At the very early stages, that just might be this thing works. Then taking that, what will you achieve during this round and what milestones will you achieve? How does that reflect onto the next round? As I alluded to earlier, I was going to talk about the VC train. That is what this is addressing. Once you raise money from a venture capital firm, they have their 10-year exit. They know very, very intimately that they have 10 years in order to exit. So in order to grow to a $1 billion company, it's very hard to do that from a pre-seed $500,000 check straight to a $1 billion valuation. So VCs will expect that you will raise from other VCs along that path. And as you break down, and as people have reviewed past examples and past companies, it comes out that you will need 5 or 6 rounds, 4, 5, 6 rounds amongst that time, which means that over 10 years, you're starting to look at 24 to 18 months per round. So the VC will expect you, once you raise money from the VC, to then be raising again in 18 to 24 months, and again in 18 to 24 months, and again in 18 to 24 months after that. And in order to achieve that at a growing valuation, you'll need to show momentum And that might be revenue, that might be product momentum, but you will need to show something that justifies new people giving you more money or less of your company in 18 months' time. So the VC will, as they are analysing the round that you're trying to raise right now, will look at what are you spending the money on? What does it unlock? How much momentum do I think that generates? Do I think that that will validate enough for the other investors? Because chances are they know the other investors and how they operate. Will know what will get them excited and what won't. And can you do that with that amount of money in 18 months? Once you get on that sort of 18 to 24 month raise pathway, it's very, very hard to get off it. You will raise money, you will then feel pressure from the investors in order to spend the money in 18 months and achieve things, and that leads to rapid purchasing, rapid hiring, all of which are perfect if the company starts growing really quickly. However, if for some reason the company doesn't start growing really quickly, which might be product development just takes a little longer, the sales cycle is a little longer than you thought it was, maybe people aren't willing to pay quite as much as you thought it did, you are then in 18 to 24 months time expected to raise, well, you need to raise more money because you have hired, you bought, and you're burning quickly. So you either need to scale the company back incredibly, which is very, very hard to do, or raise more money. If you, as a founder, are ready to get on that train, that it can be an amazing way to grow a company incredibly fast. On the other hand, once you're on that train, it is hard to get off. As I mentioned, your burn will be high, cutting costs will very much slow the momentum in the company. And there are a lot of companies that could have grown to be great SMEs, but were just torn to pieces by the pressure of being on the VC train and didn't make it. Whereas they could have made it as an SME as opposed to a VC-backed startup, which is just something to think about when you are spinning out your company, which path you take. Angel investors don't generally have quite those same expectations, and they won't start you on that train. So they can be a good way to test and validate for yourselves and de-risk the company yourselves before you do get on the VC train. On the other hand, if you do have huge ambitions and you do want to grow your company incredibly fast, often the only way to get enough money in order to spend and build a company that fast is to get on that train. So it's not a bad thing. It's just something to consider when you start thinking about, do I want to get angel money or do I want to go straight to PCs? So finally, engaging with investors. This is, again, my preferred method of doing it. There are many ways that you can engage with investors. I'm sure if you've been reading TechCrunch, you read about the sort of the 2-week raise from start to finish. It does sound amazing. However, I guarantee you that there was a 12-month lead into that raise, and it's more about that 12-month lead in that I'm talking about here. I don't believe that there is a way to shortcut a raise that fast. It's just whether it is hidden or obvious. So I would engage with investors first. I would engage with them well before you actually need to raise money from them. This enables them to get comfortable with what you're doing. It reduces the pressure on them, because if you do have a raise and you talk to them, immediately their mind is jumping to yes or no. And given how much risk VCs see in companies, that more of an alternative takes to a no. However, if you are engaging with them early, you can start to bring them along the journey, and you can start to show them some of those de-risking mechanisms. Hey, look, our team have now worked together for 6 months and we've delivered this first prototype. There's multiple levels of de-risking going on there, and you could have done that over a couple of coffees with them to update them on how you're going. It also allows you, by engaging earlier, to test quickly with VCs if they're interested in the area that you work or not. Some of them will not be interested in robotics. And the earlier that you can learn that, the less time you will spend with them over that 12 months and the more time you can spend either building the company, because raising money does unfortunately take a lot of focus away from building the company, or with investors who are interested in your area. It enables you to really focus on those that are interested, which is where you want to spend your time. You will also, by engaging with them earlier, be able to learn from them, both learn from them and learn about them. A lot of investors do generally believe that they are incredibly helpful for companies. I believe that as well for myself, but it allows you to test with them and learn along the way of if they believe that they have a really strong network. Well, over those 12 months, how many introductions did they give? Were they open with their introductions even before they invested? Were they able to introduce me to someone that really crunched a technical problem for them? Or were they able to introduce me to a customer? I like testing these things along the way, which is often known as reverse due diligence on the investor, will help you match with investors that match with you. Once they join, angels, VCs, this goes for everyone. Once they are on the cap table, possibly on the board or in an observer seat, it's very, very hard if for whatever reason you don't gel to then separate that. And there's a 10 years we've talked about. It's a 10-year pathway. It's a long time to be stuck with people that you don't get on with. So learning pre-investment whether you get on with an investor is really important. It will make what is already a hard journey much easier if you do get on with it. That covers everything that I was planning to talk about. Are there any areas that you'd like to dig into more?
How do the investors typically exit their position?
There are multiple ways that an investor can exit. There are a couple of ways that they want to exit. An IPO is generally considered sort of one of the best ways to exit when a company becomes a public company and stock is traded on an exchange, as opposed to a private company, which a startup usually is, when there are people on the investors who are directly invested in that company to be on the capital table. There are benefits and negatives of both. There's a lot of burden that comes with being a public company, a lot of disclosure that you have to give that you don't have to give to private investors. I guess it's sort of the assumption is that with the public investor, they know everything, or all of the information is given to them in order to make a decision. So the risk is on the company to give the information, whereas in the public markets, in the private markets and managers that we were dealing with earlier, the risk is on the investor to ask the question and find the information before investing. And that's where there's a ruling or a rule for early stage investments that you have to be what's known as a sophisticated investor before you can deploy over a certain amount into startups or into VC funds that haven't released a public disclosure statement. As you begin engaging with angels, that will, it's complex, but it will become more obvious.
Good. So you described kind of a lot of different stages, and some of them you might have many like individual investment rounds within them. At which points there, or with which investments would the investor expect to have a seat on the board or have like direct involvement in the way the company is run?
Yes, that is a great question. It can be investor specific. I guess the later the stage, the more likely they are to want a board seat. In saying that though, if an angel can be incredibly helpful to a company and they're willing to be on the board, then by all means. Most of the time, by the time you're looking at seed or Series A, the lead investor will probably want a seat on the board. It's probably not a controlling, they won't, if the board is 5 people, they probably won't want 3 of those seats. They may want 1, or they may want 1 for themselves and 1 for one of the other investors. It does spread some of the risk of governance. It can bring a lot more experience to the governance as well. So it's certainly not a bad thing, but I guess from a founder's perspective, you have to be aware that that is control of the company that is going with every board seat. Not ultimate control if they don't hold a majority of board seats, but it is some control. And by the time you get to Series B or C, there will probably be more investors on the board than there are founders. And in that case, ultimate control is not as certain as when it's just founders on the board. And sorry, I forgot to answer the other points of the first question as well, which we covered IPO. There's also a trade sale, which is where you sell to a larger enterprise. For an aerospace example, that would be selling to Lockheed Martin or to Boeing. Both of those are generally complete exits of both the investors and the founders. What can solve that sort of 10-year end of fund problem is known as a secondary sale, where, in fact, actually, probably context is a primary sale. When you get investment, you will create more shares in the company and people will buy those shares. So they're primary shares because it's the first time they'll be sold. Most investors in Australia will in fact not even want, they're required to hold primary shares, especially if they're what's known as an ESV-CLP, which is a type of fund that most Australian funds are. They are required to hold primary shares. A secondary share, on the other hand, is when an investor is selling a share directly to another investor without the company creating more shares. That could be a VC to a later stage VC. It could be a founder to a later stage VC or to P. But it's the difference between increasing the total share number in the company and not increasing the share number in the company. It's an effective way to get some people out without others from a company, but it's probably not considered as an alternate outcome like an IPO or a trade sale would be. Then it's sort of the worser end of the scale. You can wind up the company and sell the assets, liquidate the company, which are also effectively exits, but probably not the type you'll read about in the newspaper. And actually, just maybe getting into some details here, but liquidation preferences, which are something that a lot of VCs will require. They can be, 1x is normal, 2x, 3x are unfortunately getting heard of more and more these days. So I guess you can tell what I think about them from that comment. But that is if the company is being sold for less than the amount of capital it's raised, then people with liquidation preferences will see their money return before anyone else. And the founders don't have liquidation preferences almost ever. So that can be, when you think about raising money, it isn't just about raising money, and if I exit at the same valuation as I've just raised that, I get my percentage of the company. Investors will have clauses in there that will make sure they get the money first. That can mean the founders, after years and years of effort, separate.
So this is actually, I think this is a really good sort of pragmatic and sort of sobering sort of information. So much of this conversation is like secondary on TV, various funds, and it's a big one fact that when you raise capital, you're sort of giving up ownership to a degree, and that means you're introducing personalities to work with. You mentioned a couple of points, just like we're getting closer to the funds 10-year cycle. So invest year 4, going to 6 years, and that consultants need to make another comment about making sure you know who you're working with, so far as an investor. I was just wondering if you maybe to provide some examples of how this can actually be like a bus and maybe a little bit unpleasant for the founder, things that people maybe don't think about when they introduce investors into a startup.
Yeah, the first, I guess the first and the overarching point is that you are selling the company. So when you think about, or selling part of the company. So when you think about, what valuation do we want to raise at, obviously the investors will suggest a valuation that they are happy with. But I would urge you to think like, they're happy to buy at that price, but am I happy to sell at that price? Because it is very much a negotiation and you are selling. It's not just raising money to make the company go faster, which is one of the outcomes, absolutely. But it is, you are selling. You do need to think about it. I think the most appropriate way to think about it is like that. And then the final valuation that you land on is that point where they're happy to buy and you are happy to sell. I think people focus a lot on the are they happy to buy? Not many people focus on the are we happy to sell side. But to answer your question more directly, so in the early stages, the investors and the founders are incredibly aligned. Everybody wants to see the company grow very fast. So most of the decisions that everybody makes on the board will be similar. Yeah, invest in buying these manufacturing equipment in order to build and sell more robots, or invest in advertising in order to invest in Facebook advertising in order to generate more flow to our website. However, once things do start getting to that life cycle stage and people's intentions begin to divert, the founder might be thinking, we need to invest in order to continue growing because we haven't grown as fast as we wanted to, and I know that with my liquidation preferences not their liquidation preferences, but with the liquidation preferences that are sitting there, I need to get another $10 million of revenue before my valuation will reflect me getting a decent outcome. Whereas the investor who was thinking, I know that I'm getting my money back first, gets no added benefit from that extra $10 million of revenue. And just to run that example through, I guess using very round numbers, if you're selling a company for $10 million and the investors have say a $7 million liquidation preference, they're going to get $7 million out of that. However, if the founders spend more money and sell the company a couple of years later for $14 million, and the investors have a $7 million liquidation preference, there's more risk, more time there, which might nudge them outside that 10-year life cycle, and the investor is still getting $7 million, but 2 years later. So at that point, the investor is very, very motivated to sell, and the founder is very, very motivated to keep the company growing. And that leads to a divergence. And when that's at a board level, that can get heated if half of the board is saying, we need to start preparing for a sale, probably a trade sale if it's that close to the wire. And the founder is saying, no, I just want to pour money I don't want to pay money to an investment bank to get ready for sale. I want to spend that $1 million more and getting more Facebook ads because we know that will generate more revenue. Very hard to get those 2 points to reconcile on a board, and you get heat, friction. One detailed example, but those changing desires of people over time can lead to all kinds of friction on a board.
Got a question. So you mentioned being proactive about having answers to common questions from investors. So for a crowd who might be interested in a deep tech startup with robotics hardware involved, what are some of the questions we might expect?
Yes, it will depend on the stage. So I'll take an assumption sort of the first round that you're looking for. Investors will be wondering, can you actually build what you say you can build? Will it solve the problem that you think it will solve? Those are, on the team and product side. You can start to prove those with prototypes and proof of concepts pretty quickly. What I find can be harder to prove out is, will customers pay for this? Will they pay more for it than it costs me to build the thing? I'll also be thinking of how can I take a leap of faith that these founders will be able to continue finding the customers that they've talked about. Most founders will come with a slide deck that has a couple of logos on it, and they can be amazing logos. But the chances of those logos being able to generate $50 or $100 million of revenue from one company is really low. So the assumption that I have to make that hopefully the founder can help me validate somewhat is that over the next 5 years, they can find and sell to 10 or 20 more logos that look like that, or 100 more logos that look like that. And by showing the investors that you are already talking to more than those 3 people, that you already have proof of concepts with more than those 3 logos, can go a long way to helping validate that as well. A lot of investors, I know I said I don't focus on it too much, but a lot of investors will also focus on the market size. Just you've talked to 3 of those logos. I need to take a leap that you can find 50 of those logos over the next 10 years, but do you need to find 50 of 51 logos, which is a lot harder, or do you only need to find 50 of 500 logos? So how many of that come there is sort of a very broad way to look at market size. People shortcut that with how much revenue is spent in an industry, or just how many construction companies are there. Because obviously, I don't know, it's 30,000 because I was looking it up for a company the other day, but obviously those 30,000 are not the same. So putting a broad brush of, I think there are 30,000 potential customers might be true if it is a piece of construction software, but if you are making a new type of pile for a pile driver, it's definitely not going to be all 30,000. The investor will want to know that number, but more importantly, they will want to know that you know that number, and hopefully that you are approaching everybody within that number.
Selling and making and shipping and supporting a complex system like a robotic system, like that kind of Deeptech in the VC train that and like a process that you show, it seems like pretty difficult to that many logos. And it seems that this horizon of 10 years, it's the same for software and for Deeptech. Why is that the case? Maybe you talked about it at the beginning. It seems strange that there would be the same timeline.
It is strange that there is the same timeline because as you mentioned, like there can be vastly different company life cycles, the different types of company. If I had to hazard a guess, it's probably because people looked at what funds had as their own life cycle beforehand, and that limited partners were familiar with that, so they just copied the same thing. VCs have to sell to limited partners in much the same way that startups have to sell the story to VCs, and VCs try to take shortcuts with metrics. They try to take shortcuts by sort of pigeonholing different industries. LPs will do the same thing to VCs, so VCs therefore have to fit the mold that LPs do, and if the 10-year fund is what people expect, then 10-year fund is what they ended up by people on LPs. And the 10-year fund is what they.
What's an LP?
Oh, sorry, a limited partner.
Right.
Sorry. A venture fund will be set up.
Final, yeah.
A venture fund will be set up with the general partners who are what you would typically call VCs. Then there'll be a bunch of junior VCs underneath it who are not partners. But within that partnership, there are also limited partners, which is every single investor in the venture fund. And they are, it is a hard slog for VCs to raise money. So I guess it's, as hard as you feel that the VCs are, making you work in order to raise money from them, at least you can take a little bit of, knowledge in the fact that they've also had to work that hard in order to raise their own fund. Actually, one thing that I didn't touch on was family offices in a little bit more detail. They are sort of a merger between angels and VCs. They often don't have a stricter mandate as a VC, so they can be more like angel in terms of their preferences or their ability to do an investment if they run the family office. They work at the family office, it is much more like a VC that they have to convince IC or whoever is running the family office. However, family offices generally have an awful lot more to deploy than angels, so they're more like a VC in that way, and they'll be more sophisticated like a VC in terms of their process and the contractual documents and all that.
Just building on that, kind of a similar question. I was just wondering, with this sort of thought process in mind, with this sort of 10-year horizon, maybe it's congruous with like hardware development. Is what are your thoughts on say like bootstrapping, for example, when you can leading into that, like when you think a founder, hardware founder would feel like they're ready, when should they feel like they're ready for investment? And thirdly, like in light of this sort of 10-year funding cycle, is it better to perhaps go towards more like family office or less conventional investment style, where it's a bit more flexibility, take investment needed, not when to meet a fund time frame?
That is that is a really good question, and I guess very applicable to you as you think about spinning out a company out. I would delay as long as possible getting VC funding, because the clock starts when that happens. If you bootstrap, which is one way, and I've actually seen some second-time founders over the last 6 months who have had an exit over the last 10 years and have spent a couple of years self-funding their new companies, and now they're coming to look direct to seed or even Series A because they've self-funded. Angels, obviously that's very awesome for them because they've had an exit and they can do that. The other way to do that is with angels or grants, or potentially funding from university as well. That just enables you to get the kinks out a little bit before you start an 18-month timer for the next round. So if you are, so I'm just trying to think of a useful robotics example, but if you have a prototype, but you don't quite know how fast you can manufacture those, once you start the VC clock, I mean, if you can convince them and the next round of investors that that manufacturability is the key, not revenue being the key, then you might be fine and it might be okay to start that clock. But if you are worried that they will focus on revenue, then using some angel and some grant money in order to start testing a manufacturing line to know, okay, we can make 6 of those in 6 months' time, which means we can generate X number of revenue. You can start to de-risk it for yourselves instead of sort of starting the timer and then figuring it out at which stage it might be too late to stop. There are other reasons to take VC money. It can be quite context specific, but if you are in a very competitive industry, so every 6 months matters, maybe getting a little bit of angel to validate something is a worse decision than starting that clock and getting more money in order to move quicker. If it works, it's great. If it doesn't work, it's worse, but I guess that's the risk you're taking by taking more investment earlier. I guess founders could also think about taking on investment as its own type of risk that they can, by engaging the investor, you can start de-risking the investors team by finding out what stage of the life cycle they're at. You can start de-risking their sort of VC as a product, in my opinion. Like you can start de-risking the VC's product risks. You've got 10 years, not 6 years, in order to get to it. So it's, I would, if you can delay raising VC money, I would buy bootstrapping, buy grants, angels, or university funding.
Yeah, so I guess we've had a few questions now and a few comments in your talk about, let's say, the difference between software companies and deep tech companies. And everybody knows, like, you can have enormous growth in software companies like, Facebook or Snapchat or whatever, where a fairly small software team suddenly has 1 billion customers, right?
Yeah.
You mentioned that many investment firms are only interested in software, but some are also interested in deep tech, including yourself. Why? If software has so much upside and so little costs, and deep tech is hard and slow and riskier and stuff, what from the investor's perspective, what's attractive about investing in deep tech?
Yeah, so I could comment for myself, I suppose, not for everyone else. Everyone has their own reasons, but at a really fundamental level, I find it more interesting. You know, helps me get up in the morning when I find something more interesting. You can build a much deeper moat, or like, which is a big uses a lot of jargon, but a moat being jargon for some competitive advantage or something that slows down your competitors. If you have a unique piece of robotics, or you have a sensor that's small enough that means your robot is small enough to achieve something, that's not an advantage you can get in software. With ChatGPT and other large language models, it's becoming very quick to write software. So that, ability to build a company very quickly also means your competitors can build a company very quickly. Whereas in Deeptech, you might have a fundamental scientific breakthrough that you can utilize in a way that no one else can, or some fundamental engineering innovation that you can use that no one else can. That might patent it, which gives you 20 years in order to develop it, or you might keep it as a trade secret in order to add more risk to your company if someone else finding out, but be able to use it for more than 20 years. Actually, on patents, I have a position, at least with space companies, that a patent you have to file it and tell everybody how you've done what you've done. But if you launch a satellite into space, nobody can reverse engineer that satellite. So all you've done is tell them exactly how you've done it, and they can't reverse engineer yours, but also you can't reverse engineer theirs in order to prove that they've infringed the patent. So all you've done is tell them exactly how to do what you've done. So I wouldn't be too quick to go to patent. Like, don't get me wrong, they definitely have a place. If you're a consumer good and people can easily reverse engineer, probably do patent. Sorry, I've lost the train of where your original question was.
No, I think it was about, like, from the investor side, what are the advantages of Deeptech? But I guess the competitive advantage. Maybe on that, so you mentioned patents or trade secrets. How do you consider those sorts of assets, if you will, with the kind of know-how of the people involved in the company?
Yeah, but for me, the know-how of the people is far more important than the patent. Patent, for me, is a way to dissuade others, whereas the know-how of the company is how you're achieving what you're doing, and I care about that. Don't get me wrong, slowing other people down probably is important too, but nowhere near as important as how you achieve it yourselves.
Before we end, is there any question online? Feel free to switch on camera and microphone to ask, or just raise a hand in chat.
Good question as well. Can you talk a little bit about the actual upside downwards? If we look at like a 5-year horizon and you're a super talented founder, why would you choose the founder and a startup route over just working it better or do it yourself? This is kind of day-to-day engineering.
Yeah, it's a fair question. I think it is a question of someone's personality. There are people that don't like having a boss or want to be running a company of their own. It's not something you can do if you are an engineer at a large tech firm, whereas it is something you can do if you are founding your own company. You'll forever be your own boss. On the other hand, there are downsides to that as well. Like, you'll be thinking about the company every waking moment of your life for 10 years. It's very hard, if not impossible, to switch off. Whereas some people prefer the ability to switch off on the weekends and not have that same level of stress or risk. And that only gets more compounded when you start having employees, and suddenly you're not just worried about, my runway's only 6 months long. What am I going to be doing in 6 months? But can my employees pay their mortgages in 6 months? There's a level of responsibility that comes with that. But then, the upsides of, if you could build a company that has hundreds of millions of dollars in revenue, that's an amazing journey to go on. It's not something you can do at a large tech company. At least not in the same way as being a founder. You could spin up a division with hundreds of millions of dollars, but it's not your division. or is it that you founded the company, it's your company? And then I guess the final thing is like, working at a large tech, you can earn a lot of money working at a large tech firm, but you can truly be financially free if you've had a successful startup. But with that reward comes a lot of risk as well. I wouldn't do it for the reward, to be honest.